Mr. Seshagiri Rao now joins us. Now, Mr. Rao, so good to have you back on the channel. I think I haven't interacted with you for over 2 years now. So, Mr. Rao, first things first. What is your outlook on steel demand, given that every day we wake up to a different view from China or from US? Sometimes it is, comments which are coming from the US president, sometimes comments are coming from the Japanese PM. What is happening to the steel global market?
2018 calendar year numbers have come. The steel demand growth globally was 4.9%, so which is quite encouraging for the last year. And at the same time, if I see the Chinese steel demand in calendar year 2018 was 7.9%. So there is a very good demand for steel growth in 2018. But considering the slowdown which we see across the globe, the outlook that is released by World Steel Association for the calendar year 2019, that there will be a moderation in the steel demand. They expect the steel demand growth for calendar year 2019 will be 1.3%. That is what is expected to be. And at the same time, even China, it is expected to be 1% steel demand growth. So there will be a moderation in the steel demand globally, but at the same time, what is interesting is that there will be a growth which is 1.3% on an overall base of close to 1.7 billion tons.
Now the Indian steel market, Mr. Rao, is dramatically different. You have this artificial duty protection which has protected artificial dumping of steel. China also has mothballed a lot of capacity. So how do you see that these two scenarios will play out? Because China is now increasing capacity, and the artificial, the artificial fence, so to speak, which Indian steel companies have, that may not last for long.
I think this statement may not be correct, but if I see as far as India is concerned, whatever trade remedial actions that have been taken by India in the last few years, they are not very effective. That is getting reflected if you look at March 2019 month numbers. The imports went up by 46%, and at the same time, the exports have fallen by 16% in the month of March. So imports are coming into India in a big way because of the trade diversions. If you look at USA Section 232 imposition, or Canada or Turkey or other Asian countries, or including Europe, so there is almost 1.4 to 1.5 million tons of steel imports which have been reduced by Japan, Korea, Russia and China. And at the same period, if you look at India, it has grown by 0.9 million tons. So imports into India is growing. Therefore, that is the concern as regards to overall steel industry. India is concerned. Our steel demand last year was 7.5%, which is also very good steel demand compared to what happened globally. And even in this financial year, that is FY 19 and 20, even considering that the auto industry, there is a slowdown, despite that, overall steel demand is expected to be in the range of 7%, driven by the government expenditure, construction industry, metro, road, bridges, tunnels. So there is a reasonably a good steel demand that is expected to be in FY 19 and 20.
Mr. Rao, since you're a converter, the current volatility in global prices is unlikely to or shouldn't really be impacting you as much. What's your sense there? Is that the case? What's your sense?
Global steel prices corrected, and we are seeing a bit of stability or some uptick, majorly driven by the raw material prices. Iron ore prices are quite strong. It went up because of the disruptions both in Australia and also in Brazil. Steel prices are at a level that is quite reasonable in my view. But if I look at as far as India is concerned, the domestic steel prices are tracking the global steel prices. The landed cost of imports, particularly from China at 12.5% duty, the domestic prices are at a discount. So considering that, I expect The margins may not be as we have seen in the last year, but it will get moderated in this year, but they will be reasonable in the FY 19 and 20.
Moderation when it comes to your margin picture. Let's also understand what the outlook is with respect to your capacity. I understand that there was some furnace upgradation that was underway. Can you give us a view as to what that is going to do to your overall capacity? Is that completed now?
We are 18 million ton installed capacity, so we are expanding our capacity to 24 million tons. That will be completed by 31st March 2020. And at the same time, our downstream capacity is going up from 5 million tons to 9 million ton. Part of this capacity will get commissioned in the year 19 and 20, so that benefit would accrue to the company. But the real volume growth from 18 to 24 million ton, you will see in the year FY 20 and 21.
Base, Mr. Rao, you would say these are the base spreads which you would enjoy. You know, what Abha asked you, the fact that, you know, you're a converter and, you know, a lot of our viewers and lot of market participants perhaps don't understand that a lot of your business is insulated to the volatility in steel prices. So can you give us more, you know, light on how essentially the new capacities, when they fire in, will start adding to the top line and what kind of spreads you would enjoy?
The new capacity that is coming up is very efficient capacity in terms of investment per ton of installed capacity, and also they are very efficient in terms of fuel efficiency and also other factors. Therefore, the profitability from the new capacity will be far better than what we have right now. In addition to that, the kind of investments we are making for cost reduction, like either in power plants, coke oven batteries, pipe conveyors, slurry pipelines, there are a lot of initiatives which the company is taking to reduce our cost further. So these benefits will definitely accrue. You are right that we are a converter. Therefore, notwithstanding the volatility in the steel prices, we will continue to be profitable. That is one positive as regards to JSW Steel story is concerned.
About whole issue of coal availability. Imported coal has started again. The numbers which I looked at, I mean, what was released as per the government data, it tells you that there is a big uptick in imported coals by the power plants, and I'm assuming steel plants also would be importing it. So on the raw material side, given where the availability of coal is and you're commissioning your capacity, how are you likely to bridge that gap?
I think you have to look at the steel industry's requirements in two parts. One is the coking coal, and the second is thermal coal for the power plants which are operated as a part of captive units. Thermal coal prices globally corrected quite steeply in the last few months. So that is one positive not only for the power sector, for captive power plants of the steel industry. As regards to coking coal prices, India continues to dependent upon the imports of coking coal. So the global prices will determine as regards to the overall landed cost of coking coal. So overall demand supply scenario with regard to coking coal is not that much imbalanced. So I don't think there will be a problem with regard to overall coking coal supplies which is required by JSW Steel. And JSW Steel has also taken a lot of proactive measures in terms of diversifying the sources of importing coking coal. So our dependency on Australia has been substantially reduced. So we also import from Canada and also other countries. So that will really give some stability as regards to overall import of coking coal for JSW Steel, even at enhanced capacity of the steel production.
Mr. Rao, you know, if you could share with us the sectors, let's say 3 sectors where you see demand for steel coming back, which would they be? You know, across the board, housing, real estate, infra, like where do you really see the demand coming back?
No, government expenditure is one of the major drivers. If you see the steel consumption, which we did in the last year to the extent of 97.5 million ton, 65% of the steel consumption is coming from infrastructure and construction and real estates. In these 3 sectors, if I look at it, other than residential real estate, balance other sectors are doing quite well. If you look at, again, I was telling you that 65 towns or cities, there is metro construction which is happening. It requires a lot of steel. Similarly, government infrastructure projects, either by state or center, total together in a year they are spending almost close to 7 lakh to 8 lakh crores of rupees. So that drives the steel consumption from the government expenditure side. Similarly, general engineering and capital goods, these are the sectors where yellow goods are doing reasonably well, driven again by mining industry. So only industry which I am seeing a bit of slowdown is auto sector. The growth in auto sector for next year is expected to be maybe in the range of 2 to 4%. But as Auto Industry Association has mentioned, that it is not a structural slowdown, it is a temporary slowdown. So we expect the things to come back once liquidity improves in the market and the banks start lending or NBFCs start lending again.
Mr. Rao, great speaking to you this morning and getting a sense of the current market trends and outlook going forward. Thanks so much for joining us.